The jobs data this morning was incredibly important, hugely affecting my sentiment on the market, not just today, but for the next couple weeks, and decreasing what I see as a possible pullback that could be somewhat significant related to the ending of unemployment claims in July, social unrest continuing to that point. That bear case that I presented yesterday that I wasn't acting on, but that I was acknowledging as a possibility, just decreased significantly in possibility. Now, let me explain why. We were expecting to lose 9 million jobs in the month of May, just about how many we lost in April. Continuing with the trend, we saw some reopenings, but places like New York, hasn't reopened. Nothing's really changed, so you'd expect more people to be laid off because of that. But it looks like the Paycheck Protection Program has been working. The states that are reopening, they're reopening well. And the Paycheck Protection Program hasn't gotten the appropriate press. And we went from 9 million expected lost jobs in May to just about 2.5 million jobs lost in the month of May. It's a massive, massive change in the data from what was expected to what it ended up being in reality. So June, I feel like at this point, all the layoffs have happened. New York is opening up. New York City proper is opening up June 8th. Maybe June we lose something like 500,000 jobs. But then we get into July, we get into August. The reopenings are complete. The summer is open. People are out for the summer. We've had the highest ever savings rates over COVID, about 33%. People are taking that stimulus money, taking their money from work, taking their money from unemployment, wherever they're getting it. They're keeping it in the bank. They're putting it in the market. We're having record levels of retail investors. You guys that are following me on Instagram, ask me questions and everything, there's a record amount of you going into the market right now. And that is part of the reason why it's leading to significantly high stock prices, getting into the somewhat inflated territory given that we've had this economic damage. But if we start to level out, so if the rally is a wind-up toy, and that wind-up toy is kind of on the last legs, we were winding up on the way down, let it go, it's starting to fizzle out. If that's starting to happen and we give us some time for the economic fundamentals to catch up, for the unemployment to rebuild, for the spending to rebuild, all of that for us to get back to normal, if right now we're in a disconnected stock market to economy situation, if we can connect the two a little bit more, I'll be much happier. I'll be back to being like, all right, we can buy at these levels. And another bull rally should continue because the stock market is a forward pricing instrument. Right now, we are pricing the post-recovery era. If we allow the recovery to come in, see that positivity come in, we should expect that growth to be the next phase. We just need to confirm that the recovery is going as well as planned. And today, we had massive confirmation on that. So I am legitimately optimistic about where we're going from here, but I'm not turning that into super intense action. There's kind of a risk reward premium situation, and we're pricing in essentially the top reward, and we're taking the top risk for that at this current situation. So if that doesn't go as planned, if the economic recovery isn't as swift, then we're overpaying for the reward and the risk exchange. So we need everything to go right. There's a spectrum of possible outcomes. We're betting as a market on the better of all the possible outcomes. And it looks like that's the one that's going to come to fruition. But if it doesn't, then that's a catalyst for a downturn. And my concern yesterday was, a lot of people on unemployment. The unemployment's ending in July. Then what? Well, it looks like people are going to get the jobs back easier than we thought. We've got all of June, all of July for these jobs to come back. I'm not saying we're going to be back at the record low 3.5% unemployment we were at before COVID, but it might be something like 8 or 9% instead of 12 or 13 or 14% unemployment, which is quite dramatic. And it'll be a pretty steep drop. Hopefully somewhat similar to the steep drop we saw in unemployment and the same steep drop we saw in the stock market and the slightly less steep but relatively steep compared to past economic situations recovery we've seen in the job market parallel to that of the stock market, if that made any sense. So let's see what happens. At the end of the day, I still do have a cautious eye. I'm not taking profits right now, except in one name. I just sold some Microsoft. I've seen modest gains on Microsoft. I was a little late to the party on that one. Not super excited about the stock. I think it's gonna just grow solidly in the next couple years, but I'm not super excited about it. So I've had my profits. It's trading at a pretty high multiple. In one of my first videos, my first daily market analysis video, I called out Microsoft in particular for being inflated. It's had reason to grow over COVID. It's a better company now because of COVID. They have more customers because of COVID, but it's back at those levels. So, I'm not a big time Microsoft user. I understand the products, but I don't use them myself. I'm not passionate about Microsoft. I would rather own Apple. So I'm taking some Microsoft off the table, having that cash because we're at pretty good levels right now. Nothing too exciting. That's like we're pretty close to the ceiling, pretty close to all-time highs. This is absurdly close to all-time highs. And hopefully I will see another opportunity in the next couple days, maybe a couple weeks. I'm patient. And when the opportunity presents itself, I will use that cash from Microsoft. Maybe Microsoft comes down a little bit. Who knows? So until next time, until tomorrow, peace.